Keystone Financial. David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David independently offers securities and investment advisory services through Emeritus Investment Corporation, member FINRA SIPC.
Thank you for joining me. I work with a number of individuals for whom we're generating income. Very often, we've turned to laddered portfolios of bonds and bond funds for this purpose. Historically, bonds have been considered a safe alternative to other investment options. But today, that might not ring true. So I would like to share with you a very basic example that illustrates why this is the case. Now, there are many factors to consider when evaluating bonds for efficacy. But today, let's start with the definition of what is a bond. It is a loan. It's a loan that you make to a company, to a government, or to an agency. And the agreement is simply this: that which you loan us today, we will repay over a given number of years. And in this example, let's assume that's 30 years. The first thing that I want you to recognize is that 30 years from now, $100 will purchase 30 of goods and services in today's terms at 4% inflation. So how do we offset the impact of inflation? Well, this is where a bond's coupon rate becomes important. And in this example, we will call that 6%. So now the agreement is, loan us $100, we will repay it in 30 years, and along the way, you will receive the coupon rate of the bond. This is how we lever your principal into the income upon which you live and offset the impact of inflation. But now, let's add the Federal Reserve into this equation. 5 years ago, the Federal Reserve began taking unprecedented steps to support the economy and add liquidity. And along the way, interest rates declined to where they are today, virtually zero. As this happened, the spread between that which your bond was paying and everything else that I could find became wider. If I am a retiree looking for income, your bond paying 6% was much more attractive than any other option that I could find. Therefore, I was willing to pay you a premium for your bond. Let's call it $120. This explains the price appreciation that we've seen over the previous 5 years as interest rates have declined. So what can we expect now that we are faced with a Federal Reserve that is departing from accommodation? Well, the first thing that we can expect is that interest rates will begin to rise. And as that happens, the spread between your bond and everything else that is out there will begin to narrow. Now your bond isn't as attractive to me as it once was. Therefore, I'm not willing to pay you the same premium that I might have been willing to pay earlier. Today, I might be willing to give you $110 for your bond. If you bought it for $100, you're still in a profit position. But what if you bought that bond today at record low yields and record high prices? As the Federal Reserve moves away from accommodation and interest rates begin to rise, it is very likely that you will see the principal value of your bond decline. If you've been a bond investor and you're happy with the appreciation that you've seen, but you're nervous that we might be nearing the end of a 25-year secular bull market for bonds, I would welcome the opportunity to meet with you, evaluate your portfolio for efficacy, and discuss the options that are available to you. If you're newly retired and you're struggling to generate income in this low-yield environment, I would welcome the opportunity to meet with you as well to help you identify the options that are available to you. Generating income in this environment is very difficult, but it can be done. I hope that this example has been of benefit. Please feel free to reach us by any of the means that you see listed on the screen. For Keystone Financial Group, I'm David Guttery.